Some of Singapore's biggest, most well-known companies, they're trading at their lowest prices in an entire year. It's pretty wild, right? And it gets you thinking. On one hand, it feels like there's a massive sale happening on the stock market. But on the other hand, it could be a huge warning sign. So what's the smart move here? Today, we're going to dive deep into these stocks hitting their 52-week lows. We'll figure out why they're down, if they have a real shot at a comeback, and most importantly, how you can learn to spot the difference between a golden opportunity and a value trap. By the end of this, you'll have a super clear way to think about these stocks and a solid watch list of names that are genuinely interesting. But before we dive in, just a quick and important reminder. Disclaimer. This video is for educational and informational purposes only. It is not financial advice. I am not a licensed financial advisor. Please always do your own research or consult a qualified professional before making any investment decisions. All right, now that we've got that out of the way, let's get into it. First things first, what even is a 52-week low? It's simple, really. It's the absolute lowest price a stock has hit over the past year. For investors, it's a big signal. It screams that the mood is negative and that sellers are in charge. But, and this is a big but, it doesn't tell you the whole story. You know, I like to think of it like this. Imagine you're walking through a great neighborhood and you see a beautiful house for sale for a shockingly low price. Your first question shouldn't be, where do I sign? It should be, wait a minute, why is it so cheap? Is there a hidden problem, like a leaky roof? Or is the seller just really motivated? It's the exact same logic with stocks. The reason for that low price is everything. And right now in Singapore, there are a few big things going on. The government, through the Monetary Authority of Singapore, has been making moves that are causing interest rates to trend down. Now, that's usually good news for companies that borrow money, especially for those real estate investment trusts, or REITs. But at the same time, you've got these global headwinds creating a ton of uncertainty. Things like wild swings and commodity prices, which can really rock the big agribusiness companies. And of course, the insane competition happening in industries like telecommunications. The point is, a stock doesn't exist in a vacuum. It's all about the bigger picture. All right, let's get to the fun part, the core analysis. We scanned the entire Singapore market and filtered out all the tiny micro-cap stocks that are almost impossible for regular folks to trade. And that left us with a handful of really well-known companies. Today, we're going to look at 4 fascinating and very different examples. We've got Wilmar International, StarHub, Riverstone Holdings, and the new kid on the block, NTT Data Center REIT. So what's their deal? Why are they all in the bargain bin? Let's start with Wilmar International. Wilmar is just a monster in the agribusiness world. And here's the crazy part. Fundamentally, their business is doing great. In the first half of this year, their pre-tax profit shot up by a massive 26%. So, what gives? Well, it's all about external shocks. The company is dealing with some police investigations over in Indonesia, and on top of that, they surprised everyone with a recent dividend cut. This is a classic case of the business being solid, but outside drama making investors really, really nervous. Okay, next up, StarHub. If you're in Singapore, you definitely know StarHub. And their problem is much simpler, but it's a big one. The competition in their industry is just brutal. Their net profit took a nosedive, falling over 40% in the first half of the year. They're getting squeezed on margins and got hit with a big one-off payment for their network. This isn't just a StarHub problem, it's a whole sector problem. The telco world is a battlefield right now, and their stock price is a direct casualty of that war. Third on our list is Riverstone Holdings. Now, Riverstone is in a really specific business. They make high-tech gloves for clean rooms and healthcare. Their issue is all about cycles. You remember the pandemic, right? The demand for gloves went through the roof, and companies like Riverstone boomed. But that boom led to a massive oversupply. Now, things are back to normal, and the whole industry is sitting on a mountain of extra gloves. Their profits are down, no surprise there. But here's what's so interesting. The stock is trading at what's called a price-to-book value of 0.77. In simple terms, that means its price on the market is actually less than the stated value of all its assets. It's a little clue that suggests the stock might be undervalued, if you believe the industry will eventually bounce back. And finally, we have NTT Data Center REIT. Data centers are a hot growth area, and like we said, lower interest rates should be helping REITs. So this one is a bit of a head-scratcher on the surface. Why is it struggling so much since its IPO? The answer, my friends, is internal weakness. It all comes down to debt. Even though their revenue is growing, savvy investors are looking at their balance sheet and seeing a huge red flag, a very, very low interest coverage ratio. That number basically tells you how easily a company can pay the interest on their loans. A number as low as theirs suggests they are under serious financial strain. So there you have it, 4 stocks at 52-week lows, but for 4 very different reasons. External drama, structural industry pain, a cyclical downturn, and internal financial weakness. So what could happen next? Let's run through some quick scenarios. For Wilmar, the bear case is the legal stuff gets worse. The bull case, the issues fade away, and everyone remembers how strong their actual business is. Honestly, its future is a bit of a question mark right now. For StarHub, let's be honest, the bear case is that the telco price wars just keep getting more intense. A bull case is tough to see until something fundamentally changes in the industry. The pressure is likely to stay on. With Riverstone, the bear case is that the glove glut lasts even longer than we think, but the bull case is pretty compelling. The industry eventually rebalances, and since it's a profitable company trading below its book value, the stock could recover in a big way. And for NTT Data Center REIT, the bear case is that its heavy debt load just becomes too much to handle. Even in a booming sector like data centers, their company-specific financial risks are probably going to hold them back. Okay, so the big question. Based on all this analysis, what should you do? Again, this is absolutely not financial advice. It's just a framework for thinking. But here's how I'm organizing it. I'm putting StarHub and NTT DC REIT on the avoid for now list. The reasons they're down just seem too deep and too difficult to fix quickly. For StarHub, the industry is just a mess. And for NTT, the financial risks are just too high for my taste. The 2 I'm putting on my watch list are Wilmar and Riverstone. Wilmar makes the list because of that huge disconnect between its strong business and its weak stock price. If those external problems get solved, the stock could really move. And Riverstone is on the list because its problems feel temporary. They're cyclical. It's a solid, profitable company that looks like it might be on sale. That makes it a classic candidate to watch for a potential turnaround. So, what's the single biggest takeaway from all this? It all comes down to this one idea. Not all 52-week lows are created equal. Some are value traps, and some are potential opportunities. Your job is to understand the why. Is the problem external, structural, cyclical, or internal? That answer is your most important clue. The really special opportunities, they often pop up when a great company's fundamentals are being temporarily overshadowed by fear or bad news. Hitting a 52-week low is what gets a stock on your radar. But it's the research you do after that that tells you whether to keep watching or to just walk away. Now, I'd love to hear from you. Which Singapore stocks are you watching right now, and why? Drop a comment down below and let's talk about it. And hey, if you got any value out of this breakdown today, do me a huge favor. Hit that like button, subscribe to the channel, and ring that little bell so you don't miss our next deep dive. Thanks so much for watching, and I'll see you in the